Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about At&T Inc. annual report. At&T Inc. offers a wide range of telecommunications and technology services globally. The company's primary business segments include the Communications segment and the Latin America segment. The Communications segment provides various services to both residential and commercial customers. For residential customers, At&T offers broadband services such as fiber connections, legacy telephony voice communication services, and other VoIP services and equipment. They also provide customer premises equipment for multinational corporations, small and mid-sized businesses, governmental and wholesale customers. In addition to these services, the Communications segment sells handsets, wireless data cards, wireless computing devices, carrying cases/protective covers, and wireless chargers through its own company-owned stores, agents, and third-party retail stores. They also offer At&T dedicated internet, fiber Ethernet and broadband, fixed wireless, and hosted and managed professional services. The Latin America segment provides post-paid and prepaid wireless services in Mexico under the At&T and UNEFON brand names. They also sell smartphones through their stores, agents, and third-party retail stores. Overall, At&T Inc.'s business portfolio includes a variety of telecommunications and technology services catering to both residential and commercial customers worldwide. The recent increase in At&T Inc.'s stock price can be attributed to several key news events and strategic developments that have taken place over the past year. One major contributor was the company's positive financial results for 2025, which showed a 2.7% increase in total operating revenues and a significant 90.9% rise in net income compared to 2024. This robust performance was highlighted in its Form 10-K report, which also outlined plans for expanding wireless and fiber network capabilities. Another factor that contributed to the stock's upward trend was the upgrade of At&T's fair value estimate by Morningstar. The analyst firm cited a strengthened competitive position due to investments in fiber and 5G wireless networks, further boosting investor confidence. Additionally, the company's reaffirmation of its strategic growth plan and capital return program helped to alleviate concerns about future growth and shareholder returns. The acquisition of Lumen's mass-market fiber business was also seen as a positive move by investors, expanding At&T's terrestrial broadband connectivity footprint across additional U.S. states. Furthermore, the completion of the DirecTV stake sale allowed the company to streamline its operations and focus on core telecommunications and technology services. These events collectively contributed to increased investor confidence and subsequent rises in At&T's stock price over the past year, with the stock reaching a 52-week high of $29.79 on September 5, 2025. At&T Inc. market capitalization of $192 billion is significantly larger than the average industry peer of roughly $6 billion. This shows that At&T Inc. holds a significant advantage in their industry. At&T Inc. trades at a lower price-to-earnings ratio of 9 times and a higher price-to-book ratio of 1.73 times relative within the industry. Despite the industry trading at relatively low valuations, the stock matrix does not show much. Investors should evaluate if the business has potential earnings that is sustainable and if the assets are valuated rationally. The leverage on the balance sheet appears elevated, with liabilities of 70% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. Although shareholder equity has increased, the share count has risen while revenue is declining. This raises concerns that equity growth may be driven by dilution rather than business performance. The sustainability of the business model remains unproven. The company have a dividend yield of 4.09%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline at At&T can be identified through an analysis of various key points. In terms of revenue growth, wireless services have been a major contributor, with a 6% increase from $65,744 million in 2023 to $70,099 million in 2025. This growth is a significant positive trend for the company. On the other hand, business wireline and consumer wireline revenues have declined by 18% and 7%, respectively, over the same period. These declines are concerning and highlight areas where AT&T needs to focus on improving its performance. In addition to revenue trends, deferred acquisition cost amortization has increased from $3,667 million in 2024 to $3,837 million in 2025, indicating a growing investment in customer acquisition costs. Contract assets have also increased, reflecting the company's growing backlog of future revenue commitments. Overall, AT&T's financial performance is influenced by a range of factors, including wireless services growth, declining wireline revenues, and increasing deferred acquisition costs. By understanding these drivers, investors and analysts can gain insights into the company's prospects for future growth or decline. The net income of the company underwent significant fluctuations between 2023 and 2025. Initially, it decreased by 21.6% from $15,623 million in 2023 to $12,253 million in 2024. However, this trend reversed in 2025, with a substantial increase of 90.9% to $23,386 million. The net income also saw an increase of $11,133 million from 2024 to 2025. The profit margins of the company also experienced changes during this period. The operating income margin increased by 23.1% from 15.6% in 2024 to 19.2% in 2025. On the other hand, it decreased by 18.3% from 19.1% in 2023 to 15.6% in 2024. The EBITDA margin showed a slight increase of 0.5% from 39.5% in 2024 to 39.6% in 2025. The reasons behind these changes can be attributed to the company's investment in emerging technologies such as 5G, fiber networks, and high-speed broadband services. This led to an increase in revenue and operating income. Additionally, the sale of DIRECTV in July 2025 resulted in a significant gain of approximately $5,600 million. The decrease in legacy voice services revenue was offset by the growth in fiber and broadband services revenue, contributing to the overall improvement in net income and profit margins. The company's financial performance indicates a strong ability to generate cash from its core operations. A key indicator of this is the positive operating cash flow, which measures the amount of cash generated by the company's daily business activities. In 2025, the company reported a significant increase in operating cash flow, with 3 separate metrics all pointing to a positive outcome. The first metric, as stated on page 32, shows that cash provided by operating activities reached $40,284 million, a clear indication of a positive operating cash flow. This is further reinforced by the net cash provided by operating activities figure on page 46, which also stands at $40,284 for the same year. The operating cash flow summary for 2025, as reported on page 89, provides additional evidence of the company's ability to generate positive cash from its core operations. With a total of $1,334 million in operating cash flow, it is clear that the company is successfully managing its finances and generating sufficient cash to support its business activities. Overall, these metrics demonstrate that the company is indeed generating positive operating cash flow, which is a crucial indicator of financial health and stability. The company's debt level and interest expenses have undergone significant changes in recent years. According to the extracted summaries, the total debt increased from $123,532 in 2024 to $136,100 in 2025, representing a notable rise of 10.6% in long-term debt carrying amount. This increase is also reflected in the debt-to-equity ratio, which rose from 50.7% in 2024 to 51.4% in 2025. Despite these increases, interest expenses have remained relatively stable, with a slight increase of 0.7% from $6,759 million in 2024 to $6,083 $804 million in 2025. However, it's worth noting that the net change in interest expense is actually a decrease of minus $45 million when comparing 2023 to 2025. Overall, while debt levels have increased significantly, interest expenses have remained relatively stable, indicating that the company may be managing its debt effectively despite the rise in borrowing costs. The company's performance varied across different segments and regions. The communications segment stood out as a strong performer, with the mobility and consumer wireline divisions generating significant operating income. Additionally, fiber and advanced connectivity services saw good results due to increasing demand for high-speed broadband services. In contrast, the business wireline segment struggled, experiencing declining revenue from legacy services and an operating loss of $816,000. The Latin America segment also had mixed performance, with operating revenue growth but low operating income margin. The North America segment showed some positive trends, including increased 4G LTE coverage and fiber consumer wireline broadband customers. However, specific revenue or income metrics were not provided for this region. Overall, the company's results highlight areas of strength and weakness that will require attention in future planning and strategy. Management is optimistic about the company's outlook, driven by growing demand for broadband services due to emerging technologies such as streaming, augmented reality, and AI. To capitalize on this trend, they plan to accelerate fiber expansion through organic investments and strategic acquisitions. The focus will be on owned and operated connectivity services powered by 5G and fiber, with a goal of covering over 441 million people with 4G LTE and over 322 million with 5G technology in North America by the end of 2026. To drive growth, management emphasizes the need for innovative services, plans, and devices that bundle product offerings and take advantage of 5G wireless networks. They also plan to invest in expanding industry-leading fiber network to lead in wired connectivity and prioritize efficient spectrum deployment and construction of high-capacity broadband solutions. Additionally, they expect significant capital investment in expanding network capacity and obtaining additional spectrum. Management acknowledges the decline in revenue from legacy services as they decommission their copper-based network, but sees this as an opportunity to focus on fiber and advanced connectivity services for growth. They plan to take targeted pricing actions to offset revenue declines in certain markets. Overall, management's strategy involves investing in 5G and fiber infrastructure to drive growth and meet increasing demand for broadband services. The company has made several strategic acquisitions and divestitures in recent years. On the acquisition side, the company has purchased spectrum assets and fiber assets to enhance its network capabilities. Additionally, it acquired Mobility II preferred interests and Tower Holdings preferred interests, which provided significant funding for the company. In terms of divestitures, the company has been actively shedding non-core assets. This includes decommissioning legacy business wireline products and copper networks, which are no longer needed or relevant in today's digital landscape. The company has also redeemed outstanding Series B cumulative preferred shares and repurchased Mobility II preferred interests as part of its efforts to streamline its balance sheet. Furthermore, the company has terminated its authorization to repurchase common stock, indicating a shift towards more strategic investments rather than share buybacks. It has also entered into a structured sale-leaseback agreement for real estate, generating significant upfront cash proceeds. Finally, the company has been actively repurchasing equipment installment receivables, which will help reduce debt and improve its financial position. Overall, these acquisitions and divestitures demonstrate the company's commitment to strategic growth and financial discipline. By shedding non-core assets and acquiring key infrastructure, the company is well-positioned for future success. The company has a history of returning value to its shareholders through both dividend payments and share buybacks. In terms of dividends, the company has consistently declared a payout of $1.11 per share since 2024, with actual payouts totaling $8.2 billion in 2025 and $8.2 billion in 2024. This demonstrates a commitment to rewarding investors for their loyalty. In addition to dividend payments, the company has also engaged in significant share buybacks. In 2025, it repurchased approximately 159 million shares worth around $4.3 billion. These efforts aim to boost shareholder value and create a more stable financial position for the company. There are concerns about inventory buildup or supply chain disruption. The main reasons for these concerns include difficulties in obtaining export licenses, inflationary pressures, inability to secure component parts, general business disruption, natural disasters, safety issues, economic and political instability, and supplier financing obligations. These disruptions can have a material impact on the company's ability to acquire needed goods and services, leading to delays or unavailability of handsets, equipment, and software. The increase in direct supplier financing outstanding and vendor financing obligations from 2024 to 2025 also suggests that suppliers are facing financial difficulties, which could further exacerbate supply chain disruptions. The potential consequences of these disruptions include inventory buildup due to overstocking, reduced sales due to unavailability of products, and damage to the company's reputation. Therefore, it is essential for the company to address these concerns by diversifying its supplier base, improving logistics and transportation systems, and developing contingency plans to mitigate the impact of supply chain disruptions. That concludes the financial summary for At&T Inc. Feel free to comment below, and I will be happy to answer them when possible.